Welcome to the Deep Dive. Today, our mission is to cut through the complexity of one of the fastest growing sectors out there, enterprise software and services. We're going to be tracking its explosive growth, and we're zoning in on the big one, Salesforce, and its huge pivot into AI.
And it really is the engine room of modern business. I mean, when we say enterprise software, we're talking about everything. ERP for finance, CRM for sales, supply chain management, the works.
And the evolution has been so fast, right? We've seen, 3 eras already?
Yeah.
From that old on-premises software.
The stuff in the server room in days.
Exactly. To the cloud model we all know now. And today, we're deep into this third stage, the AI-powered phase.
And that third stage, it's not just another feature. It's a critical inflection point. So today, our job is to stitch together market growth projections, some competitive analysis, and a look at Salesforce's financials. We want to understand what's driving this whole sector and how a giant like Salesforce is trying to use AI, specifically this Agentforce platform, to stay on top.
Okay, so let's start with the scale. Just how big is this market and how fast is it really moving?
The trajectory is stunning. The global market size started around $258.4 billion back in 2020. By this year, 2024, it's already hit $381.3 billion. That's a compound annual growth rate, or AGR, of about 10.2%. And for you, that KGR figure, it's just the average yearly growth over that time. It's really solid.
But the forecast, that's where it gets even more aggressive, isn't it?
It is. The growth rate is actually predicted to accelerate. Between now and 2029, we're looking at a 12% CGR. That means the market is on track to hit something like $671.7 billion by 2029. It's almost doubling.
Wow. Why? What's behind that acceleration? What are the big forces at play?
It's sort of a perfect storm. It comes down to technologies, infrastructure, and just plain necessity. First, you have the tech itself, especially breakthroughs in deep learning. And this is key, the massive drop in computing costs. AI used to be incredibly expensive.
And now it's not. That changes the game for big companies.
Totally. The second driver is the infrastructure that supports it all. The constant upgrades to networks, to computing power, to storage. But the third one is maybe the biggest. It's enterprise demand. Companies everywhere are facing labor shortages and rising costs, so they're under huge pressure to get more efficient. And right now, digital transformation is the only real way to boost productivity.
Which means software spending stops being an optional line item and becomes a core strategic investment, a total shift in thinking.
It's the new strategic asset, yeah. And we see that in the IT spending data. Software as a share of total IT spending is set to grow from 4.5% this year to 5.3% by 2029. And this is all because the cloud is no longer an option. It's the default.
And that move to the cloud sets the stage for the AI boom, which in turn forces another round of spending.
That's the key dynamic right now. AI is creating all this new demand for intelligent apps. But here's the critical part. The old legacy systems, they just can't handle the data loads or the AI models. They just can't. So enterprises are being forced to upgrade everything. It's creating this massive replacement cycle across the entire market. And that's what's fueling that 12% growth forecast.
So the message is upgrade now or become irrelevant in 5 years. Speaking of markets, let's talk about the US versus China. They're the two biggest, but structurally they seem like different planets.
Oh, they're two different worlds. In the US, companies love standardization. They want software that works out of the box. It means implementation is fast and the costs are predictable.
But in China, it's a lot more complicated.
Much more. Chinese companies, especially the big state-owned ones, often need these highly customized systems. They're built for very specific local rules or business practices. One source called it the clash between the global template and hyper-local customization. And that just slows everything down.
And you see that reflected in how much they spend on IT.
Exactly. U.S. firms see IT as strategic, so they'll spend, more than 5% of revenue on it. In China, it's typically less than 5%. But that lower base means there's huge growth potential there, especially as the government pushes them to modernize.
And security concerns change how they adopt the cloud, too?
Yes. The U.S. is all in on the public cloud, but big Chinese clients, they really prefer private or dedicated clouds. It's about security and compliance. Same with subscriptions. The pay-as-you-go model is standard in the US, but it's only just now gaining real traction in China, mostly with smaller businesses.
So what's driving China's growth then? How are they catching up so fast?
It's two big things: government policy and security. First, the government is pushing digital transformation hard with plans like the 14th Five-Year Plan. Second, and this is huge, is the information technology application innovation movement. It's basically a push for companies to use domestic software because of supply chain security fears. That's a massive tailwind for local Chinese software companies.
And no matter where you are, Beijing or Boston, AI is the common thread, isn't it? It's shifting software from just being a logbook.
From record-oriented
To being predictive and decision-oriented.
It is the engine for the whole next cycle, and it's forcing everyone's hand, including Salesforce.
Okay, so let's pivot to Salesforce. The undisputed leader in CRM, they've got about 19.5% of the market, which basically puts a giant target on their back.
Right, and their strength has always been that recurring subscription revenue. If you look at their core products, you can see where they expect the growth. Service Cloud, which is all about customer care automation, is projected to grow at a strong 15% CAGR. Sales Cloud is a bit more mature, projected around 9%.
And what about the newer stuff? I see Platform and Other, which includes Slack and their new AI work, is forecasted at 8 to 11%. That seems like a pretty wide range.
It is, and it shows you the uncertainty around new product adoption. But it's also where all the investment is going. Marketing and commerce is also key, looking at 7 to 9% growth, mostly from AI-powered marketing tools. Geographically, they're still very much an Americas-focused company. About 2/3 of their revenue comes from there.
And financially, they seem pretty healthy. Gross margins are up over 77%, net margins are breaking 16%, and a lot of that is from some pretty aggressive cost-cutting, right? Layoffs and that sort of thing.
It is, but what's really interesting is how their capital strategy is changing. They're acting like a mature, cash-generating machine now. Their debt is manageable, around $9.5 billion, and their recent moves show a ton of confidence in their future cash flow.
And that confidence is being passed on to shareholders.
Exactly. They started paying a dividend 40 cents a share. For a tech growth stock, that's a huge signal. And they returned over $9 billion to shareholders last fiscal year through buybacks and that new dividend. They're clearly shifting priorities.
So now we get to the big pivot, Agentforce. What is this thing, and how is it supposed to move them beyond just being a CRM?
Agentforce is their play in autonomous AI. It's about workflow automation. So instead of a salesperson having to manually log a call or draft a follow-up, the AI agent does it. It can read a customer's email, figure out the intent, draft the next steps, schedule a demo, and log everything in the CRM, all without a human touching it.
So it's moving from a system of record to a system of action, and the numbers suggest it's catching on.
Very quickly. The AI unit is already at a $1.4 billion annualized revenue run rate. They've signed up over 9,500 paid deals already. It shows that their deep focus on CRM is giving them a real head start in the AI race.
But it's not cheap. They're planning to spend $8 billion to buy Informatica, a data company. So I have to ask, is spending $8 billion to basically clean up your data for AI, is that a sign of strength or desperation?
That is the big question. And I think the answer is, it's both. It's strength because they can afford to make a move that massive, but it also highlights a huge weakness across the entire software industry: messy data. AI agents are totally useless without clean, integrated data. Informatica is the plumbing they need to make Agentforce work. They have to buy it, or their whole AI strategy could just fall apart.
And even with that, they're still playing defense against some absolute titans. The competitive risk here feels enormous.
It's what we're calling the big tech arena. I mean, look at Microsoft. They are a massive threat. They've got Dynamics 365, sure, but the real weapon is Copilot, their AI assistant, which is being embedded into everything in Microsoft 365. They're trying to intercept the sales process before a salesperson even opens their CRM.
And then you've got Oracle and Adobe attacking from different sides.
Oracle is a beast. It has powerful cloud infrastructure, OCI, and they're going hard on industry-specific AI. And Adobe's a huge competitor on the customer experience front with their creative tools and Firefly AI. Salesforce has to innovate constantly just to hold their ground.
Okay, let's talk about the economic environment they're doing all this in. We have all these AI tailwinds, but the global economy is tricky.
It's a very strange environment. You have stubborn inflation, high interest rates. I mean, the Fed funds rate has shot up, and GDP growth is slowing down. Some models even predict a contraction for Q1 2025. All of that caution makes companies delay big IT projects if they can.
And yet, Salesforce's recent results looked surprisingly strong.
They did. Their Q3 adjusted earnings per share crushed estimates, coming in at $3.25 when Wall Street expected $2.86. And their Q4 revenue guidance was also strong, pointing to 11 to 12% growth. Though the Informatica deal will add about 3 points to that.
But the metric you really need to watch if you want to know how healthy they are is the CRPO, current remaining performance obligation.
That is the crystal ball. For anyone less familiar, CRPO is basically contracted revenue that they haven't billed for yet but will in the next 12 months. It's locked-in future revenue. It's the best indicator of business health. And Salesforce's CRPO grew 15%, which blew past the 10% expectation. That tells you demand is actually getting stronger, not weaker.
And that resilience is why they feel confident enough to put out that really ambitious long-term target, right? Over $60 billion in revenue by 2030.
Exactly. It implies they believe they can get back to double-digit organic growth year after year. But getting that kind of predictability is a whole science now. It takes incredible discipline, clean data, and layering AI over everything to move beyond just gut feel forecasts.
So wrapping this all up, it sounds like Salesforce is navigating this incredibly complex environment pretty well. They're leveraging their lead in CRM, they're making a big, decisive bet on autonomous AI with Agentforce, and they're spending big to shore up their data foundation. They seem to be holding their own against some of the biggest companies in the world in a really tough economy.
I think so. The key success factor in this market has changed. It's now about your R&D capability, how fast and how well you can embed new tech, especially AI, into what you already have.
So the product you sell isn't really the software, it's the R&D engine that's going to make that software obsolete and require a mandatory upgrade tomorrow.
That's it, exactly.
Yeah.
This constant need for system upgrades means that even the most established software is always operating on borrowed time. It creates this continuous, accelerating market cycle for the companies that can keep up. So I'll leave you with this thought to chew on. Given how fast AI is moving into everything, just think about how many major software systems in your own professional life are probably due for a mandatory AI-driven overhaul very, very soon.